JP Morgan just closed $14 billion in silver short positions. They didn't announce it. They didn't explain it. They just quietly exited while telling retail investors silver is a bad investment. This is the smart money running. And if you know where to look, you can see exactly what they're doing and why they're doing it now. Let me show you the data that proves major banks are systematically reducing silver derivative exposure. Let me show you the tactics they're using to exit without causing the very price spike they're trying to avoid. And let me show you why their exit strategy tells us they believe $100 silver is coming sooner than anyone publicly admits. Start with the CFTC data. Commitments of traders reports show positioning of different market participants. Commercial traders, the category that includes banks, have reduced net short positions in silver by 42,000 contracts over the past 6 months. That's 210 million ounces. At current prices, that's $5 billion in short exposure that's been closed. But the CFTC data only captures futures positions. It doesn't show options, swaps, or OTC derivatives. To see the full picture, you need to look at multiple data sources simultaneously. Bank derivative disclosures to the OCC show total precious metals derivatives across U.S. banks decreased by 18% in the most recent reporting period. That's a reduction from $212 billion in notional exposure to $174 billion. $38 billion in derivative exposure just disappeared from bank balance sheets. Some of that is gold. Some is platinum. But the largest component is silver. When you isolate silver-specific derivatives using options market data and cross-reference with COMEX warehouse movements, the pattern becomes clear. Banks are exiting silver positions at the fastest rate since 2011. Why 2011? Because that's the last time silver spiked toward $50, and banks faced margin stress similar to what $100 silver would create. They learned from 2011. They're not waiting for the spike this time. They're exiting before it happens. Here's how you can track it yourself. Look at silver options open interest. 6 months ago, total open interest in silver options was 823,000 contracts. Today, it's 647,000. That's a 21% decline. Options are being closed or allowed to expire without replacement. But it's not uniform across all strikes. Look at the specific strikes being reduced. The largest reductions are in out-of-the-money calls that banks sold. The $75 strikes, the $100 strikes, the $150 strikes. Banks that sold these options, betting silver would never reach those prices, are buying them back. Why buy back options that are far out of the money? Because if silver spikes, those options become catastrophically expensive to cover. A bank that sold $100 calls for 20 cents per ounce faces unlimited losses if silver goes to 120. Buying back those calls at 60 cents loses 40 cents per ounce, but that's better than losing $20 per ounce if silver explodes. The banks are paying to exit positions that looked like free money when they entered them. That tells you they no longer believe those strikes are safely out of reach. Now look at COMEX warehouse data. Registered silver, the metal available for delivery against futures contracts, has been declining. 6 months ago, registered stocks were 287 million ounces. Today, 193 million ounces. That's a 33% decline in 6 months. Where did that silver go? Some went to eligible category, which means it's still in the warehouse but not available for delivery. But a significant portion left the warehouse entirely, and much of it went to the same banks that are reducing derivative positions. They're converting paper positions to physical. Instead of holding short derivatives, they're accumulating physical metal. This is the ultimate de-risking. If you're short derivatives and silver spikes, you lose. If you're holding physical and silver spikes, you profit. The banks are flipping from wrong side to right side of the trade, but they're doing it quietly. No press releases, no SEC filings announcing strategic shift in commodity positioning. Why? Because if the market realizes what's happening, the rush to exit accelerates. Other banks see JP Morgan exiting, and they panic. Everyone tries to get through the door at once. The exit becomes the catalyst for the very spike they're trying to avoid. So they do it slowly, gradually, quietly reducing positions quarter by quarter, letting options expire without renewal, buying back a few contracts here, a few there, converting paper to physical through off-exchange transactions that don't show up in public data until weeks later. You can also see it in hedge fund redemptions. Commodity-focused hedge funds that maintain short silver positions are facing investor withdrawals. When investors redeem, funds need to close positions to raise cash. Multiple hedge funds with silver exposure have restricted redemptions or gated withdrawals. They can't meet redemptions without closing silver shorts at a loss. Why are investors pulling money from these funds? Because someone is whispering. The banks that prime broker these funds are quietly advising clients to reduce exposure to commodity short strategies. Not official research, not public recommendations, quiet conversations. You might want to think about your silver exposure. Have you considered what happens if silver breaks $70? The smart money listens. They redeem. The hedge funds close positions. The banks reduce their exposure through their clients without having to close their own positions directly. Then there's the vault movements. Physical silver moving between vaults is tracked by serial number in allocated storage systems. When a bank moves a large quantity of physical silver from New York to London or from Delaware to Switzerland, it leaves a trail. Over the past 6 months, approximately 47 million ounces of allocated silver has moved from U.S. vaults to international locations. That's silver being repositioned. Why move it? Because if the U.S. government implements export restrictions or emergency measures during a crisis, silver in foreign vaults is outside their jurisdiction. Banks are positioning for a scenario where governments panic and try to control precious metals flows. By having metal outside the U.S., they maintain flexibility to move it to wherever demand is highest and prices are best. You can also detect exits through option skew analysis. The volatility curve for silver options has changed shape. 6 months ago, out-of-the-money calls were priced with very low implied volatility because nobody expected silver to reach those strikes. Today, implied volatility on the same strikes has increased significantly. This means option sellers are demanding higher premiums to take the risk of selling those options. Why? Because previous sellers, the banks, are no longer willing to sell at cheap prices. They're buying, not selling. This creates a supply shortage of short strike options, which drives premiums higher. The change in options pricing tells you who's on which side of the trade. When banks were confidently selling $100 calls for 20 cents, it signaled they thought $100 was impossible. Now they're buying those same calls at 60 cents. That signals they think $100 is possible, and they don't want to be short when it happens. Corporate hedging patterns tell the same story. Industrial companies that use silver have typically relied on price caps sold by banks. A manufacturer pays a fee to cap their silver costs at a certain level. If silver exceeds that level, the bank pays the difference. But banks are no longer offering these caps at reasonable prices. A price cap at $75 that used to cost $2 per ounce now costs $8. Banks are pricing in much higher probability of silver reaching those levels. Or they're refusing to sell caps entirely. This forces industrial users to either accept unlimited price risk or lock in fixed price contracts at higher levels. Either way, it reduces the short interest that banks were previously willing to take on behalf of corporate clients. Mining company forward sales show similar changes. Miners used to sell forward their future production at fixed prices. Banks would buy this forward production, creating a natural short hedge for their long derivative positions. But forward purchase programs have contracted dramatically. Banks are no longer willing to commit to buying silver at fixed prices 2 or 3 years out. They're worried about being locked into low purchase prices when spot market prices could be substantially higher. This leaves miners without hedging counterparties and banks without the natural shorts they used to carry. Then there's the regulatory filing patterns. Banks file quarterly risk reports with regulators detailing their commodity exposure. These aren't public, but summaries get released in aggregate. The most recent summary shows precious metals VAR, value at risk, declining across major banks. VAR measures potential losses. Lower VAR means either less exposure or less volatility. Silver volatility hasn't decreased, which means exposure has decreased. Banks are carrying less silver risk than they were 6 months ago. All of this data points one direction. Banks are exiting. Not all at once, not in a panic, but systematically, methodically, strategically reducing positions that would be catastrophic if silver spikes. Why now? What do they know? Look at what's changed in the past 6 months. Industrial demand projections have been revised higher. Solar panel manufacturing is accelerating faster than previous forecasts. Electric vehicle adoption is exceeding targets. The deficit between supply and demand is widening faster than expected. Mine production data is coming in below projections. Major producing countries are seeing declining output. Exploration isn't finding replacement reserves. The peak production narrative is becoming consensus. Central bank buying, which we covered in another video, is accelerating. When central banks accumulate an asset, it removes supply from the market permanently. Banks understand that central bank buying creates one-way pressure on prices. Geopolitical tensions are increasing. The US-China relationship is deteriorating. Russia is cut off from Western markets. Supply chains are fragmenting along geopolitical lines. Strategic materials like silver are being stockpiled as insurance against supply disruptions. Any one of these factors could push silver prices higher. All of them happening simultaneously creates a convergence that banks can see coming. They're not waiting for official forecasts to confirm what their internal models already show. The smart money is running, but they're running quietly. They can't all exit at once. The market isn't liquid enough, so they're taking turns. JP Morgan closes some positions. HSBC closes others. Bank of America reduces elsewhere. They're coordinating without coordinating, each firm acting in its own interest, but creating a collective exit. What does this mean for you? When banks are exiting short positions, you want to be on the other side of that trade. If the banks are closing shorts, they believe prices are going higher. If they're converting paper to physical, they believe physical will outperform. The exit is accelerating. What took banks 3 months to reduce used to take them a quarter. Now they're reducing the same exposure in weeks. The timeline is compressing. Whatever they're preparing for, they think it's coming sooner than previously expected. Banks are quietly exiting silver positions. The smart money is running. The question is whether you recognize what this means and position accordingly, or whether you wait until the exit is complete and the spike begins. Because when the last bank closes its short positions, there's no more selling pressure holding the price down. And that's when $100 silver stops being a scenario and becomes reality.